I'd like to start by thanking Jeff Abarbanel. You know, that shampoo conditioner thing. I can see that saving me a lot of time going forward. Okay, I learned a lot yesterday, and one of the things I learned is that 10 minutes goes by really quickly. So I'm going to jump right into this, and in fact, I'm going to skip a few slides. Bear with me. I want to jump to one of Mark's slides, and we will try to stay on time, and I'm going to... Bill Nichols is not only an accounting professor, he's an associate dean of the Mendoza College at Notre Dame, and he has some say over my raise every year. So I think I'm going to keep it pretty much to 10 minutes. He's told me I better. Now, this is one of Mark's slides, and this jumped out at me, and I really, one thing here, and I think I'm not, by the way, I'm not going to contradict anything that Mark said. In fact, I'm continuing with his theme of the topic is analysts or analyst forecasts. Sorry, Peter, we've taken over the session. And one thing on here jumps out at me. One thing resonates with me, and that is our interest in how capital markets operate. Why do we still study analysts? I think most of us because we care how capital markets operate. And I changed this just a little bit, and I said, and this is going to be the theme of of my talk today, why do I care about analysts? I admit I've personalized this. I care about analysts because I care how capital markets operate. I care about how and why prices change. And that's the only reason that I study analysts and analyst forecasts. Sometimes when I meet somebody, they'll say, oh, you're an earnings guy. And I say, well, I think or say, yeah, well, I am an earnings guy, but it's because I care about capital markets. It's not so much that I care about earnings per se, but I care about capital markets. And when you think about it, when you think about earnings, think you get 4 observations every year for every firm that you care about. And they're not self-selected. I think earnings is a great laboratory for looking at what happens in capital markets. Okay, well, why I care about analyst forecasts, despite their imperfections, yes, they are better than time series forecasts. And again, I'm not disagreeing with Mark. I think it's right to look at how much better are they. Are they economically significantly better? But even if they weren't, and I'm going to say something that's on my last slide today, even if they weren't better, analyst forecast errors represent a component of surprise that is not captured by time series forecast errors. And actually the reverse is true. So we have 2 measures of earnings surprise: time series forecast errors and analyst forecast errors. And if you care about controlling for or measuring earnings surprise, I think it's important to use both. I think if we went back to a paper that Mark mentioned, Brown, Griffin, Hagerman, Zmievsky, 1987, one of those 2 papers, I think that paper says that the information in analyst forecast errors does not subsume the information in time series errors. Okay, let me continue. The stock market cares about analyst forecasts, therefore I care about analyst forecasts. We know that we see price changes around revisions. And finally, I think they are incredibly useful tools for capital markets research. I can already tell that I'm being wordy, so I'm going to try to get right into this. Do analysts exhibit the inefficient behavior of which we accuse investors? This is actually point number 7 on Mark's talk, and I think this is very important. And he mentioned all these things, so I'm not going to spend a lot of time on it. I love the picture he put up. I will just echo what Mark said, and that is that one of the first things I learned as a doctoral student was whenever you look at long-term returns, you're testing a joint hypothesis. Does this sound familiar? You know, you're testing market efficiency, and you're testing the particular return-generating model that you're assuming. Well, I think when you use analyst forecasts, agreeing completely with Mark, you get around at least quite a few of those issues. And again, since this is Mark's point number 7, I'm going to go to the next one. Here's another use, and I'm talking about, why do I care about analysts? And I certainly consider myself a user of analyst forecasts much more than a studier of analyst forecasts. Here's something I find interesting. I haven't really done any work in this area. Do price movements convey information about future cash flows or, for example, about changes in liquidity, changes in investor recognition, etc.? There are several papers that show when it's announced that a firm is listing on the New York Stock Exchange, the price goes up. Now, why? Well, it could be because this is a signal of higher future cash flows. Or, if you think of a paper by Amahud and Mendenhall, or multiple papers by them, it could be because investors are anticipating an increase in liquidity. That should make firms more valuable. Or if you think about a Robert Merton paper, it may be investor recognition. By looking at what happens to analyst forecasts around the time of the event and correlating the revision with the returns at the time of the event, I think we can add some evidence to this issue. Okay, and I've given some examples. And let me just say, it's easy to make mistakes in this line of research, just like it is in every line of research, and not pointing at any particular paper. Okay, continuing. Do different investors use different information sets? Building off Neil Bhattacharya's 2001 paper, my colleague of mine at Notre Dame, Robert Battaglio, and I were able to show in a JFE paper last year that it certainly seems like investors who initiate small trades have earnings beliefs, earnings expectations that look like a seasonal random walk forecast. Investors who initiate large trades have earnings expectations that look like analyst forecasts. So we were able to get two completely different results. In fact, when you correlate the buying behavior of the largest group of investors and the smallest group of investors, around the time of an earnings announcement, that correlation is just about zero. They're not doing the same thing. Okay. Here's an open question. Can we identify some investors whose expectations are more sophisticated than those of analysts? This is something that Robert and I have talked about. We've talked about how we might do this. Large investors' expectations look like those of analysts, but they might actually be better than analysts, and that's something we're looking at. Also, I've heard people talk about ECNs, electronic communication networks. People have told me, people who study market microstructure have told me that perhaps people who trade on ECNs are more sophisticated than people who trade on the New York Stock Exchange or NASDAQ. So possibly, I don't know how to do this, but I'll just throw it out. Possibly people who trade on ECNs have expectations that are more sophisticated than those of analysts. Okay. We are still finding fascinating phenomena that have implications for how capital markets work. I apologize for the alliteration and the hyperbole, but I do find this fascinating. We have two results. When you look at the beginning of a year, or shortly after shortly after the earnings announcement comes out, when you see a large dispersion in analyst forecasts, we see two phenomena. It turns out that the average of those forecasts were very optimistically biased. It also turns out that returns over the course of the year are low. Now, I was a reviewer on an early paper that said this, and I almost rejected it just out of hand. I thought, wait a minute, big dispersion means low returns? Too simple. But I replicated it, and sure enough, other people have replicated it since. The question is the linkage large? When we have large dispersion, are analysts optimistic, and do investors follow the analyst's lead? Or is it when we have large dispersion, that's indication of large disagreement among investors, and optimists set prices? It's been interpreted both ways in the literature. Open questions. What more can we do with dispersion? For example, could we relate forecast dispersion to the elasticity of demand for stocks? We believe that stocks do not have horizontal demand curves. Most of us do. I shouldn't say we do. Most of us do. If there is broader disagreement among the value of a stock, it should have a steeper downward sloping demand curve. If work has been done in that area, I'm not familiar with it. Okay, I think I'm just about finished. I have some final thoughts. If you really want to capture or control for earnings surprise, use both analyst forecasts and a time series model. In accounting and in finance, we often have a dependent variable, and we have one independent, or maybe a couple of independent variables that we care about, and then we have control variables. And often you say, well, couldn't your result be due to this? And people will say, I've controlled for that. See, I've got a variable in there. I've controlled for that. Well, I think if you claim to have controlled for earnings surprise and you don't use at least one time series variable, one time series surprise and one analyst-based surprise, then you're not trying hard enough. That would be my comment. And my last two comments are just basically, I don't think are that important. Surveys of analysts should be viewed with skepticism. My comment on the block survey is this. Block surveyed randomly chosen AIMR members. Today there are 47,000 AIMR members in the United States. Do you think, on average, they have the same level of sophistication as the analysts that we study, those who submit their forecast to IBIS? I just question that. So I'll throw that out. Probably everything should be looked at with skepticism, so not a very strong comment. My final comment is I don't know, not very significant. Recent regulation changes should make the future interesting. That's all I have. Thank you. I think I'm on time.